Gold has been hitting new records for the past several years. On January 29, 2026, it reached a new all-time high at $5,500. Prices have pulled back since then and are now near $5,000, which is still a significant amount. We have not seen a rally like this in decades. Gold has always been a store of value, yet the current levels would have sounded extreme not long ago. What stands out is the speed. The demand for gold did not build slowly over time. It moved quickly. In past periods of economic or political stress, investors usually shifted into the US dollar or US treasuries. That was the standard reaction. This time, more money is moving into gold. And it's not just gold. Take a look at silver as well. In January, it reached a record price per ounce. The nature of that surge is what really caught people's attention. It feels less like a normal market move and more like a warning sign that people are becoming increasingly anxious. Gold has always been seen as the ultimate safe haven asset, almost like a heart rate monitor for the global financial system. When it rises this fast, it usually means something is wrong in the system, and your first real question should be, what exactly is gold signaling right now, and what does it really mean for the world? Warren Buffett has long criticized gold as an investment. It pays no interest, no dividends, and it costs money to store. He once said that buying gold is essentially a bet on rising fear, the idea that others will become more worried over time. Meanwhile, gold has often performed well during periods of economic stress and uncertainty. Many investors turn to it when confidence in other assets weakens. Gold also carries no default risk. It is not a liability issued by a government or a company. A country can default on its debt, but gold itself does not depend on anyone's promise to pay. When someone holds gold, they own the asset directly. It does not generate income, yet it has preserved value during past financial crises. When gold moves up this quickly, investors are usually looking for safety. They use gold as protection against inflation and uncertainty in the economy. Debt is rising across major countries, and purchasing power is falling. Because of that, some investors are moving part of their money into assets they believe are more stable. Gold is one of the main places they turn to. But one of the biggest drivers of gold prices right now is a global uncertainty. Geopolitics is a major factor here. After the Russia-Ukraine conflict escalated, Western governments froze a large share of Russia's central bank reserves held abroad. That move changed how other governments looked at their own reserves. If assets in dollars or euros can be frozen, they're not fully safe. Since then, many countries have tried to cut their dependence on dollar assets and lower the risk of future sanctions. When we talk about countries, we're mostly talking about central banks. They have been steadily purchasing gold over the last few years. Even though, in the early 2000s, central banks were net sellers. They were putting hundreds of tons into the market each year. That has changed. Between 2022 and 2024, central banks purchased more than 1,000 metric tons per year. According to the World Gold Council, about 863 metric tons were bought worldwide in 2025. Poland, China, India, and the Czech Republic were among the biggest buyers. The European Central Bank reports that countries now hold around 36,000 metric tons of gold. That is roughly 20% of all the gold ever mined. In other terms, gold holds a meaningful place in official reserves. China deserves special attention here. The People's Bank of China added gold for 18 months in a row, starting in 2022. It now holds about 2,300 metric tons of gold, placing it among the top 5 official holders worldwide. Meanwhile, China has reduced its holdings of U.S. treasuries after once being one of the largest foreign holders. The goal is clear: build a system that relies less on the dollar. Gold supports that plan. It cannot be frozen. It cannot be sanctioned in the same way as foreign currency reserves. And no one can create more of it with a printing press. This brings us to the US dollar. For decades, the dollar was the safe haven when things got unstable. Governments trusted the US system and parked their reserves in treasuries. If you wanted safety, you held dollars. That was the standard approach. That's how things worked. And the dollar was more than just a currency. It was the foundation of America's global dominance. But over the past 20 years, this status has gradually weakened. And recently, the shift has started to move faster. In 2015, the dollar made up about 66% of global central bank reserves. By 2025, that number had fallen to around 58%. The dollar still dominates, but the trend is moving in the opposite direction. Some central banks are slowly moving part of their reserves into other assets. The freezing of Russia's dollar reserves forced many governments to reassess the risk of relying too heavily on the dollar. That is where gold comes in. It is not tied to any government's promise. It does not depend on a central authority, and it cannot be frozen in the same way as dollar assets. Because of this, more countries are moving toward a system where the dollar is no longer the only center of global finance. Now, it's also important to understand that the Trump administration wants a weaker US dollar. A weaker dollar makes American exports more competitive abroad and can support domestic manufacturing. Adding to that, the dollar is facing pressure from other directions as well. Morgan Stanley Research projects that the dollar will fall another 10% by the end of 2026. Foreign investors have been adding hedges to their exposure to U.S. assets, which will likely weaken the dollar. Concerns are also growing around the independence of the Federal Reserve. For decades, the Fed has been seen as one of the pillars of global finance stability, largely because it has operated without direct political control from Washington. Now, that trust is being tested. The White House has openly criticized Fed Chair Jerome Powell, and President Trump has pushed for lower interest rates. If rates are cut for political reasons rather than economic ones, inflation could come back. Markets don't wait when that kind of uncertainty appears. And historically, when confidence in central bank independence weakens, investors look for protection. The inflationary period of the 1970s in the United States illustrates how fast inflation can get out of control when it isn't handled properly. Not long ago, President Trump chose former Fed Governor Kevin Warsh as his preferred replacement for Jerome Powell, who is set to step down in May, partially because he favors lower interest rates. What that means is that interesting times are very likely ahead. Trade policy and the overall direction of the U.S. economy are adding more uncertainty. Yes, the U.S. dollar is still the main reserve currency. It makes up about 58% of global reserves and is involved in roughly 88% of foreign exchange trades. But some investors are starting to doubt whether U.S. Treasuries can still be seen as the safest asset in the world. U.S. debt is projected to keep rising for years, and political divisions in Washington are only adding to the risk. Confidence in U.S. growth has weakened. Uncertainty increased further around the so-called Liberation Day tariffs in April, when markets began questioning the impact on the American economy and inflation in particular. And after Trump's big beautiful bill passed Congress, attention shifted to rising long-term deficits and how the government plans to cover them with more borrowing. Gold demand has also increased thanks to ETFs. These funds let investors buy gold without holding the metal. Before the first gold ETF launched in 2003, it was much harder for retail investors to get direct access to gold. Today, buying gold through an ETF is as easy as buying a stock, especially during periods of market stress, when stock prices become more volatile. In recent years, ETFs have seen some of the largest inflows on record, even stronger than many traditional rate-based models would have expected. Gold is often described as having intrinsic value, but it can still attract speculative money. In October 2025, the World Gold Council said that fear of missing out on the rally made more investors and wealthy individuals increase their gold holdings, often by moving some money out of stocks. Over the past few years, a large amount of capital has flowed into tech companies, pushing many of their stocks to very high valuations relative to earnings by early 2025. And if the AI boom turns out to be more hype than the real deal, gold may once again look like a safer place to put money. At the start of 2026, there's still a lot to worry about. Conflicts around the world are still ongoing. Tensions between the US and Iran are growing faster. Relations with China are tense due to ongoing trade wars, with tariffs being introduced back and forth. Political uncertainty is rising in several major economies. You can also add that there was the longest government shutdown in United States history, the debt is at a record high, money is being printed, and the global economy feels fragile. Old alliances are being tested, and new ones are starting to take shape. So, when investors look for safe assets, gold stays at the top of the list. Nothing about gold has changed. What has changed is the environment. The rally we're seeing reflects the mood in the system. Gold moving higher is not just about price. It shows that confidence is not as strong as it used to be. Still, not everyone thinks currencies or government bonds are about to lose their role. If trade wars calm down or a peace deal is reached between Russia and Ukraine, gold could pull back. Thanks for watching. Please hit the like button and subscribe for more content like this one. It really helps support the channel. And what do you think? Is gold sending a real warning signal, or is this just another cycle that will fade? Share your opinion in the comment section down below, and I'll see you guys in the next video.